Now to perhaps the most important story in the world that is not getting the attention it deserves: the still skyrocketing cost of shipping. A 40-foot shipping container, one of those big metal boxes you see everywhere, from China to the U.S., now may cost $20,000 to rent. Consider last year they were $3,000 or $4,000. It's putting holiday shipping and holiday shopping at risk. But it is not just that. The cost of liquefied natural gas and those ships has soared from $5 to more than $15 per unit of LNG. So with all these insane prices, are there companies who may win from this? Let's bring back in Randy Gibbons of Jefferies. Been following this for a while. Some of his stock picks, they have certainly turned out very well, Randy, and we and our audience appreciate it. Any sign that these prices are slowing down? I mean, this is just getting bonkers at this point.
Hey, yeah, great to see you, Brian. A few things are going on. Obviously, on the container side, demand remains robust, right? Everyone wants all of these goods from Amazon and Walmart and Target, and they have to get them from Asia, right? So you've continued to see increased spending on goods, especially now with lockdowns looming, back to school shopping going, holiday shopping about to get into full force. And the supply of ships, the container ships, is very low for the time being. We're looking at 2 to 3 years until you start to see some new build orders. So for the container rates, the container shipping goods, that is certainly going to be strong at least until next Chinese New Year, right? You have port congestion extremely high and all of these other factors. So our favorite pick there is certainly ZIM, Integrated Shipping, ticker ZIM, and Danaos Shipping, ticker DAC. Now you mentioned LNG and nat gas, right? What a difference a year makes. A year ago, I'm here in Texas, we were giving away crude and nat gas. Now you're at multi-year highs for both of those commodities, right? Nat gas is above $4 MMBTU. International LNG prices are above $15 per MMBTU. So pretty massive spread there. And what you're seeing is additional U.S. LNG exports going out the door. Not much new production here. So that's certainly rising nat gas prices here in the U.S. And same abroad, right? When you had a very, very harsh winter back in January, February.
Yeah.
Throughout Asia, throughout
But Randy,
Europe,
the commodity is up, and had the spike came down, but is rising. We saw the graphic. But does that translate to the shippers, the ones you covered? Do they make more money from it?
Absolutely, right? So the biggest thing is a geographical arbitrage opportunity. Put it simply, it's cheaper in one region than it is in another. And that's what you're seeing on that chart there as well. When you see the Northwest European price at a discount to the JKM, or the Japan Korea marker, the Asian LNG price. So the only way to capture that spread is to put it on a large LNG carrier. You basically take the molecules, take the LNG at a lower price from Europe, ship it over to Asia, and then you have that arb window. So that's one reason that shipping rates remain elevated. The next one, as Proverbs 6, you got to increase your inventories in the summer to prepare for the winter, right? And that's what's happening throughout Europe, throughout Asia, because right now the market's in contango. Not talking about dancing and tango. The prices forward are higher than they are currently. So these importing nations in Europe and Asia say, you know what, we better get our LNG today before prices go higher in future months. And that is pushing up shipping rates, because the only way to replenish inventories is by importing more LNG on these LNG carriers.